Hello, everyone, and welcome to the Kentucky Small Business Development Center's weekly webinar. I'm glad you took time out of your busy day to join us. I'm Dave Etkin. I'm the director of the SBDC Center here in Louisville, Kentucky. So as I see a lot of you just kind of starting to come in and get settled, but before we get started, I'd like to take a few moments to share some information about the Kentucky SBDC. The Kentucky Small Business Development Center is the only statewide nationally accredited program that provides entrepreneurial and business development services to assist Kentucky's entrepreneurs and small businesses at every stage of their life cycle. For almost 40 years, the Kentucky SBDC has assisted emerging and growing businesses by providing professional expertise, tools, and information necessary for entrepreneurs to start, fund, and grow their businesses. We do this at no cost, thanks to the U.S. Small Business Administration, the University of Kentucky, as well as regional universities, colleges, and local economic development agencies. To learn more, visit us at KentuckySBDC.com. There you'll find additional resources to help start, fund, and grow your business. To request personal assistance, shoot us an email at info@KentuckySBDC.com or give us a call at 1-888-414-7232. If you look to the right of your screen, you'll find the chat feature. If you have any questions for our presenter today, you can post them there, and we'll get to them at the end of the presentation. As always, just to test that everything's working and you can hear me loud and clear, see our screen, do me a favor and jump in that chat and tell me where you're joining us from and say hello. Again, I'm Dave Etkin. I'm the director of the Louisville Center. I'm one of 17 centers throughout the Commonwealth of Kentucky. And a recording of today's webinar will be emailed to you later on this afternoon, so take a look at that. Today we have such a great topic that we need to kind of adds on to what we've been talking about the last couple of weeks. But, you know, if you ask yourself this question, would you like to have a business that is easy to manage, generates good cash flow, and is a top market performer? Well, there is a way to do that, and today's presenter is going to help us explore that a little bit. David Pierce is an accomplished CPA. He's been a decade with Deloitte and PwC, and he's had several C-level posts with different banks. He's got a ton of experience, serial entrepreneur, owns several businesses. He's a great resource. He is a certified Petra coach and just recently joined the Value Builder system, and he's going to talk a little bit about what we need to do to make a valuable business that gives us good returns. So, Dave, good to see you today.
Thank you. Good to see you, David. I'm not old enough to have done all those things you just said I've done in my past. So I don't know how it was all accomplished. I'm only like 29. So anyway, appreciate you having me today. I am excited to talk about our topic, Value Builder, and so it's called the Value Builder system, and kind of the outcome of the Value Builder system is an increase in value of your business. But the real purpose of the Value Builder system is to increase performance, eliminate risk, and the ultimate outcome, by doing those things, you will increase the value. So I don't want you to get caught up on this value thing. It is kind of the end result of all these value drivers that we're going to talk about. But ultimately, you want to build a business that's higher in value each and every day. And that's what these value drivers will help you do. And in turn, at some point, if you do sell, hopefully you've created a business that's going to outperform and yield a higher price multiple than your industry may command for the average business. So let's get into this, the Value Builder system. Slide about me, David Pierce, Petra coach. At the end, I'll show this up again at the end of the session, so you can get my email. At the end, I'll show you this slide again. Today's agenda, I want to give some insights about value builders. I always think it's important to validate what we're going to talk about. So I'm going to give some insights and statistical information about the system. It's been proven with 50,000+ companies of its success. So I'm going to go through some of that. Then I'm going to give you some case studies, real companies that have taken some of these drivers and improved them in their business. It ultimately yielded an exit much in excess of what their industry might command. So proof and validation more through real case studies of some of the value builder processes. And then I want to review the process. I always get asked, well, what does this look like if we go through the process? I'll give you a quick overview of how you would implement this and go through the specific drivers so you can see what those are. And you can take those and begin to look at these in your own business. Obviously, you can do that on your own, or if you want to do some other things with us, we can talk about that at a later date. So the value builder outcome is we help businesses improve performance and reduce risk. Both are very important, which leads to increased valuation. So the outcome is not just to get your company to be more valuable, it's to do these things within your company that are going to add value as you go through the process. They make a statement that you get double the value and double the offers. And they've statistically proven this by looking at the 50,000, 55,000 companies that have gone through the process, many of which have exited. And they find that those that go in and raise this overall score, it is a scoring matrix that you'll go through. If you raise your score above a 90, and I'll explain this a little later how we go through this, you tend to get a multiple that is twice that of the average business. So double the value. And I'll show you some examples of today of real companies that have done this and much higher than double. So by raising these value drivers within your business, you're going to inherently get a better price at some point in time, or your company will at least be more valuable. And you get double the offers. Same thing. Go back and study the companies, the ones that were sold or were put on the market to be sold. The ones that had the highest scores were getting on average 2 to 3 times more offers than the average business in the database. So who uses Value Builder? Who uses these drivers? First, the obvious one is somebody that wants to sell their company. People will come to use the Value Builder system and say, I've got an exit strategy in 3 years. I really want to do some things to improve the value, so when I exit, I can get the maximum value. That's one user who might come and want to use the Value Builder system and work on these drivers. The main user is just you, somebody who wants to improve the performance of their business, profitability, revenue, growth, and reduce the risk within their business. That's the primary user of this, which really applies to any business. And then the third category, which could be a lot of you too, is that person, that entrepreneur who's built a business that they really don't enjoy. They've gotten themselves, we call it the owner's trap. They're in the owner's trap and they're working 24/7. They're the total point of contact with personnel, customers. They do all the sales, everything. And it's no longer a joy to them. So by implementing some of the value drivers, you can reduce some of this exposure to yourself, this bottleneck that you created for yourself, and create a more enjoyable business. So those are some of the outcomes of that. So what drives valuations? Again, valuation is kind of the end game. It's the measurement on how successful these things are. But I do want to talk about valuation because it is important that we understand where valuations come from. First of all, this slide talks about size. Size of the business does drive the valuations. The larger the company, they tend to command more from a pricing standpoint than a smaller company in the same industry. And the real reason for that is a buyer knows the larger you get as a company, the less impactful the owner is on the success of the business. Because you get to a certain size, you can only grow to a certain size if you're the only point of contact. You handle everything. So the bigger you get, you cross those thresholds, then a buyer has more comfort that there's not a lot of risk of the owner going away because the business is so sizable. They would have had to build processes and procedures and personnel to run the business outside of the owner or the selling person. So size does matter, but primarily because of that. And then the industry. Obviously, every industry is priced differently. An industry that's in command, high demand, is going to get a higher multiple, and those go in and out of chain. This slide just takes a point in time and shows some different industries and the various average multiples of industry. So every industry has a different pricing multiple based on the demand for that industry. I want you to take a look at that very last one. That's the administrative. So somebody's in clerical or administrative type services, they tend to have the lowest multiple valuation. And this is a multiple of net earnings, not a multiple of revenue. So this slide indicates that you've got less, around a two times earnings would be the value of the average business that falls into this administrative category. So just kind of keep that in mind, because that's going to come back it's something we talk about in just a minute. But every industry is going to have a different multiple. So size does matter, and the industry you play in is going to matter. But I believe those are not the main determinants of valuation. In the value builder system, we've identified 8 drivers that if you excel in those 8 drivers, you can raise the value in such a level that you well exceed the industry averages of the pricing. So I would say there's things within your business that if you're aware of those and you focus on those and you make buyers aware of those, you can command a much higher price than just industry and size would yield for you. And that's what we're going to talk about, those value drivers that every one of us can look at within our businesses and attempt to raise or protect those that we do really well. So what I want to do is I'm going to walk through 3 or 4 of the drivers. I'm going to explain the driver. I'm going to give you an example, a real life example, to show you the value of focusing on that driver and what it did to these companies when they exited. So the first one is recurring revenue. That's kind of obvious, but after coaching a lot of companies and seeing a lot of companies over my lifetime, we don't spend a lot of time thinking about creating recurring revenue. We just want to sell, whoever we can, how much we can, and don't really put a lot of intentionality into generating recurring revenue. Very important. I work with not a lot, but I work with some private equity firms, and they'll go in and actually analyze the revenue streams of these companies that they're acquiring, and they'll assign a higher value to the recurring revenue stream versus the one-off or the transactional revenue stream. So it's a very important driver of value. We just don't spend enough time on it. What the data would show is that companies with 75% or more recurring revenue in their revenue stream have a higher multiple of valuation than just the average industry. Roughly about 2 times, let's call it, a little over, right at 2 times the average multiple. And that's for the average business if you have just that driver at 75% or more of your recurring revenue. So very important, and it will impact you. There's 9 models of recurring revenue that we use, and we work with companies that we help them think through as options that they may want to adopt within their business. Some apply, some don't. There's like 9 different models that we work through to help you, the business owner, think through what might work in your business. One of those is called the subscription model. And here's a real life example. There's 2 owners, Mr. Panda and Mr. Burkhart. They own a company called H. Bloom. And they make this statement: our revenue, in fact, our entire business is very predictable. That's a very important term, predictability and recurring revenue, because we know how many subscribers we have each month. So they know in a given period of time, forward-looking, generally know what their revenue is going to be, because a high percentage of their revenue is recurring revenue. And let me tell you about them. H. Bloom, you might think, they're in the florist business. And if you know anything about florists, typically they're somewhat low margin businesses, and they're very expensive to market. You've got to have a nice retail shop. You've got to have delivery vans. You've got to have a lot of marketing, because you want to be in front of the potential buyer when that need for flowers or arrangements comes up, for the birthdays and for graduations or a funeral or something of that nature. So you want to be there when they're thinking about those things. So you've got to constantly put yourself in front of them through either your shop, your visibility there, or through some kind of marketing effort. And it tends to be very transactional. I mean, you may have customers that come back year after year, but it's a birthday here and it's a birthday there and it's an anniversary here, and you really never know when they're going to come to you. So it's a very transactional. really, if you look at it, the customer value is only about $29 on average for a typical florist. Another big factor in the florist business is they have a high spoilage rate. These flowers, as soon as they're cut, they begin to die. So they've got a very limited shelf life, and the average florist throws away 55, 60% of their inventory before it's sold. So they've got to build that cost into their sales price so they can make up for this. So high spoilage. So what these guys did, they sat down one day, they were in the business, and they were the typical florist, and they said, man, there's got to be a better way. There's just got to be a better way. So they literally got into a boardroom or a room with a big whiteboard. They got out their customer list, their customer data. They started analyzing all their customers. Who was buying what were they buying, how often were they buying, and they analyzed and fragmented and dissected their customer base. And they found a very interesting segment of their business, which was buying. They were buying high price things, and they were buying on a regular basis. And this segment was the hotels and the restaurant business, which kind of makes sense. High-end restaurants, high-end hotels, they like to have fresh arrangements where it makes their environment very attractive. So this segment was buying from them on a regular basis, although they didn't really have a method to attract it. And they said, well, that's a great segment. Why don't we build a business where we can set up a subscription service for that segment, and that'll be where we go. And they did. And the most significant piece of their business now comes from that segment of the business. And they've done a couple of things because of that. It's a subscription service, so they know what they're going to deliver over whatever time frame for that customer. They know the money is going to be coming in. They know what flower arrangement they need to buy for the upcoming subscription cycle, whatever it is, if it's weekly or bi-weekly. So successful, they raised the lifetime value of a customer from the 29 transactional number to $4,500 per customer. So they had to have fewer customers that delivered much more revenue. These were high-end customers, so they had a premium pricing on their product, even though it was a subscription. So they made more money. And maybe the biggest factor of all is their spoilage rate, because it was so predictable, went down from the 55 to 60% down to 5%. So they were throwing away a lot fewer flowers. They only ordered what they needed for the upcoming cycle. Again, predictability and recurring revenue were very important. I think they're still in business. I have no record of them being sold, but I would venture to say if they sold, they would command a huge multiple versus what the typical business in that industry would, because of that focus on recurring revenue. So that's one of the value drivers. You may have an opportunity in your business for something in the recurring revenue stream. A couple other examples. Amazon has turned everything they sell into a recurring revenue stream possibility. You can, if you buy vitamins, they offer you the opportunity to buy them on a regular basis. If you buy coffee, regular basis, air filter. Amazon knows the value of recurring revenue. So they basically enable just about anything you buy from them that would make sense, you can opt to get on a recurring basis with them. And they love to do that. They give you a little discount to do that. Other things I've seen really creative, air filters for your home. Typically you go to Lowe's, Home Depot, go buy a filter whenever you ever think about replacing your filter, which I've unfortunately done sometimes and left it in there too long, but go and buy your filters and replace them. Well, they know that you should replace those on a regular basis. Better for your system, better for your air quality. So air filters now can be bought on a subscription basis. Coffee, beer, wine, anything disposable, diapers, paper products. So there may be an opportunity with your business you haven't exploited yet that could be converted to some kind of recurring revenue stream. Makes you more valuable. Typically, you're more profitable because you're more efficient and you add value to your business. So a lot of different opportunities there. All right, next value driver, monopoly control. Now, what we're talking about here is there's something in your business that you do better than anybody else in the industry, or you're the only one that does that because you got some proprietary knowledge or some proprietary people or some process or a product that nobody else has. That's monopoly. There's something you do better than others, or you have control over that nobody else does. Maybe an early entry into something, you've created something that nobody else has. That's called monopoly control. If you have that, it makes you more valuable because of a couple of things. Typically, if you have something like that, you can charge a premium price, and there's often a large market for those things because nobody else has it. So you do increase profitability, and your revenue streams will grow because of this typically, because it's protected. So is there anything in your business like that? That's the point. That's the revenue. That's the value driver that we're talking about. Let me talk to you about a case study. A real company here. This is Jill. Jill answers phones. She had a company called Ruby Reception. So they were an answering service. So they'd be a call center or something for a business, or just a receptionist for a doctor's offices, whatever. She ended up selling she had a company that had $11 million in revenue. So let's say she had a 20% profit margin. So she had she was making about $2 million a year at the time. She sold this $2 million income stream for $38 million because of a monopoly she had built within her business. What she did is, and I'm sure a lot of companies now have this, I don't know the time frame for this, but she built a proprietary routing system. So then when calls came in, they efficiently routed calls to the right person, could make their employees more efficient. They could handle more calls. They collected the right data, good back-end system. She had this proprietary call system that she developed that nobody else had in the industry. And because of that, she was able to command a higher price when she sold, because the buyer said, man, that's great. How can we use that? So what the buyer for her company was a private equity firm. They had several companies that could use this answering service type software. They said, man, we could drop this into all of our businesses, make them much more efficient, and raise the value of our whole portfolio by having what Ruby Receptionist has. So they thought about, could we create this ourselves? Probably could with enough money, but the time could, maybe competitors could enter the marketplace. It would be a slower process. So they said, well, it would be worth us to pay a Ruby Receptionist, pay Jill a significant multiple to get that, because we know we can exploit it within our own portfolio. And that's exactly what they did. They paid $38 million for a company that might have been making about $2 million a year. Very successful. She had a monopoly. She protected it, and she leveraged it by selling it to somebody else who could further leverage it within her portfolio. Much more valuable. Remember, she's in the administrative business, and that was the 1.8 to 2 times multiple business on average. So she well exceeded that multiple because she built value within her business, which wasn't based on the industry or the size of her business. Again, studying the companies that have been through this value builder process, if you have a monopoly, you tend to get 50% higher offers on average, maybe even more if you're like Jill. All right, owner's trap. I kind of mentioned this early on. This is one of the buyers. This is typically the entrepreneur or the owner who has built a business and they're not real happy because they've got themselves into what we call the owner's trap. The name we use in our value builder process is called hub and spoke, but here's the way the process works. You are in the center as an owner or kind of the senior team. You're in the center of this. You start a business and you're the salesman. Obviously, you go out and sell the first products and you get a few clients or customers in, and you say, well, maybe I could sell some more stuff to the same people. I'm talking to them. So you add products. And again, you're the one selling the products. So you're the only one that knows the products. And you soon are selling everything to everybody, and your time commitment is going way up. You're the only one can do it because you started. You haven't had time to train anybody else because you're too busy selling to the next person. So you're beginning to create this trap or bottleneck because you don't have time to train somebody, because if you do, your business is going to suffer. And then when the customer calls, they want to talk to you because you're the point of contact and they know Jim by name. So you're in this endless cycle. It's called the owner's trap. many, many, many entrepreneurs get into this trap because this kind of just the way it naturally progresses. And what happens when you're in this trap, when you leave, your business slows down. So you tend to not leave. You're the point of contact when any problem happens, and you reach a plateau because you've only got so much bandwidth to sell. Now, the bandwidth may be great, and you may be doing well, but I'd venture to say if you weren't in this trap, you could do even better than you're currently doing today. A great example, I've got a friend who owns a landscape. I was just talking to him this week. Interesting. Owns a landscape company. Been doing it for 40 years, started the company. He was, just like I just said, he was a salesman. He created the products and developed new product lines. And he's a face of contact. Everybody knows him. He's a customer contact. And he is just that. He does extremely well. Venture to say he does extremely well, but he's in that trap. I said, tell me your typical day. He said, well, come in the morning, follow up on what was left over from the day before. I set up the crews. Often I'll go out with the initial crew and kind of get the day started. Then I'll come back to the office and work on sales calls. In the afternoon, I'm out delivering proposals. And at night, I'm writing up proposals. And every day is like that. And weekends as well. Saturdays, he works 5 or 6 hours. Sunday, he works 5 or 6 hours. I said, you ever get away? They've got a nice beach house. He says, yeah, I get away about, we'll get in there 6 times a year. He says, but when I go, I do work. So he goes away, but he doesn't go away. So that's the owner's trap. So you need to do things to get out of the owner's trap. Now, from a buyer's perspective that comes in and looks at your business, this is the risk element that I alluded to earlier. If your business is totally dependent on you for basically everything, you are not going to get as much for your business as somebody that has a very diversified business where you're not in control. There's a lot of exposure to a buyer when this owner's trap exists, because if you go away, then his business, the buyer's at risk of losing business because of that. So the greater the owner's trap, the lower the value. So you need to get out of that by training people and bringing others in. So the way we assess is we go in and ask you a series of questions about your business. And within the 55,000 companies that this has been done on, they've determined that the way you answer questions will determine the scores you get within each of these drivers. So the questions are going to range from, I know everybody. I know all my customers by name. They're on my database. They call me, text me all the time. Versus, I don't know any of them by name, and I rarely deal with a customer directly. The second answer will yield a higher value because a buyer essentially will be, there's less risk in your business as perceived by a buyer. Now, you need to know your customers. I'm not saying you don't need to know your customers, but you don't need to be the only person in the cycle that handles everything with your customers. So it is important you know your customers, who your key customers are, that kind of thing. But you should not be the single point of contact. If you are, you're going to limit the value based on that of your business. This is really more of a risk reduction thing more than it is a performance enhancement. But lowering risk raises value, and this is very important to you. It also is a satisfaction thing. If you do this well and kind of get out of this ownership, you will enjoy your job and your business more, so that you're not an owner that doesn't like their business anymore. So if you do these things, you will improve your quality of life in and outside of your job. Example, Breedlove and Associates. This is Stephanie who owned Breedlove and Associates. Let me tell you her story. Stephanie was a consultant at one of the national consulting firms, and she hired a nanny to come and watch her household while she was working. And what she found out, and I've never had a nanny, but she had to pay her nanny as a paid employee, not as a contract employee. So she had to create a payroll system to pay her nanny. She said, well, okay, I'll call ADP and figure out, I've never done it before, but I'll call ADP, one of the payroll providers, and do it. Well, she quickly found out they weren't really interested in the nanny business. It's one employee, wasn't really worth their time and effort to set up a payroll system for one employee. So Stephanie started thinking, said, there's got to be a lot of families just like ours that have nannies. And I got to believe they're going through the same thing I'm going through and figuring out how to pay this nanny as a paid employee. So the more she thought about it, the more convinced she said that he thought there was an opportunity. So she eventually said, well, I'm going to create a payroll service for nannies, and I'm going to go sell it to all these households that have the same need I do. So she ended up quitting her job and starting this company and created this payroll system. As you can see, she had a $9 million revenue company that she sold for $54 million. $54 million. Let's say she was making $2 or $3 million. She had a multiple of, 20 something percent, probably 20 times earnings of her system, of her company that she was able to sell this for. Now, what she did is she had a company she had built. So let me talk about the owner's trap real quick. What she did early on, this is the owner, she thought about it. She had a few customers and she had $300,000 or $400,000 in revenue. And she was beginning to think about, well, these are families, they own houses. Why can't I sell them maybe landscaping and home care and cleaning? And she went through that conversation with herself and maybe her team. And the good thing is they decided against that. They said, no, let's just get real good at the payroll service for nannies. And we'll just build a bit. It might be a slower build, but let's do it really well. So she made the choice that resulted in her avoiding the owner's trap that I talked about, so much so that she created a really valuable company and sold it for a huge multiple. Now, what did she do? So she built her business. She was at about 10,000 customers at the time when she sold. Let's go back and look. She was about 10,000 customers. It was making $9 million in revenue at the time. She went to a company called care.com, and they're like the Angie's List of care providers. So they had a subscription-based service where people subscribed to their service and they could look for anything from lawn care to cleaning to pet care, whatever. They had 7 million subscribers in their database. So Stephanie said, hey, care.com, I got to believe of that 7 million, there's a big percentage of them that have the need for just what my company does is they have nannies and they need a payroll service. So just if 1% of your 7 million took advantage of my service, you would 7 times the value of my company, basically overnight, leveraging the customers you've already got. So they were convinced that was good. So they did, and they offered a huge premium for her to buy her company, and they leveraged that into their customer base. And I got to believe they were successful of selling this Breed Love and Associates nanny payroll service to their care.com subscribers. Huge multiple because she avoided the owner's trap. And she also did something else I'm going to talk about that also improved the value as well. Probably was a big driver. All right. Customer satisfaction. Another driver, very important. We see this in all our businesses that we coach as something that they need to focus on. Even if they're good at it, there's always room for improvement. And by improving that, they always improve performance and efficiency within their business. So what is this? One easy way to measure it is called the Net Promoter Score. You probably have heard about this or maybe even used it in your business, but basically it's a statistically valid method to survey your customers to determine how satisfied they are with you. And it's based on a question. How likely are you as a customer to recommend us or our products and services to others? It is a statistically valid method for measuring how satisfied your customers are if you do this over time. It's not a one-off survey and you use that forever. You do it on a regular basis. And it will create a very valid trend of how you stand with a customer satisfaction level. There's a book called The Ultimate Question 2.0, I think it is, that talks about this methodology. It's a statistically proven method. It's been used on tens of thousands of companies. We use it in all the companies that we coach, and we use it ourselves as well at Petra Coach. The point is, you've got to measure customer satisfaction, and then you've got to do things within your business to raise that level. So you got to know where it stands first, and that's what the NPS score does. We know companies that have traditionally very high customer satisfaction levels are valued much higher than other companies in their same industry. Some examples here are, Harley Davidson, Google, Apple, Eventbrite, all have really high customer satisfaction scores, net promoter scores probably. and they tend to be valued much, much higher than the typical business. So customer satisfaction is a big driver of value. It's also a big driver of revenue growth, profitability, and efficiency. So what is Net Promoter Score? Real quick. It's a survey. It's a one-question survey, basically, you take, and you ask your customer how likely are you to recommend our products and services to others. And you rank them from a score of 1 to 10. 10 is, I recommend you to everybody I see. I even go out and look for people to talk to about your business and service. You know, that's a 9. Those are promoters. That's a 9 or a 10. If you give me a 9 or a 10, you're that kind of person. You're talking about me all the time, my company, my products and services. If you give me a 7 or 8, those are classified as passives. And, you know, I like your product. I'm not really wowed by your service levels or whatever you're doing when I interact with you, but I'm not talking bad about you. I'm just, it's okay. So they're called passives. Anything 6 or below is called a detractor. Chances are detractors are negative, having a negative impact on you. They're talking bad about you. They're not recommending you. In fact, they're maybe telling people not to work with you or not to buy from you. So they're called detractors. So the score is calculated. You take the percentage of promoters, less the detractors, you throw out the passives because they're neither hot nor cold, and you come up with a score. And if you can see by the math, your score could be a negative 100 to a positive 100. There's a range of 200 points there, depending on how the question is answered. The higher the Net Promoter Score, the higher the value of the business. Businesses that have a Net Promoter Score of 50% or plus are considered to be somewhat world-class. I will tell you that Google, Microsoft tend to be in the 60s, 70% range, and they're like they're the best of the best. So if you can get 50% above, you are doing really well. So you've got to measure it, and then you got to take actions, and you got to remeasure. So over time, you'll have a good indication of how you do in customer service. It raises value. I would venture to say that Stephanie's secret was her customer service level. She had an NPS score of 78%. And she was very intentional about that. She realized that the initial contact with that customer was the only time they had to interact with them. Once I was on the payroll service, I didn't have much interaction unless there was a problem. So the only chance I had to wow this customer was when they came onto the system. So they built just a outstanding onboarding team and onboarding process. So when I went through it as a customer, I'm wowed and I'm impressed and I loved every minute of it, and it was easy. And I'm going to go tell the next person about that service. So she spent a lot of time and effort doing it right, focus on that niche, as opposed to selling a lot of crap to everybody else. And in turn, had a really high customer service Net Promoter Score. I got to believe the buyer, Care.com, looked at that and said, man, we got something to learn here too. So her customers are loyal. So the good thing about a high customer satisfaction level is they buy more, they stay longer, and they refer you to others. So increase in performance and probably efficiency, because you got fewer customers you got to deal with, the ones that stay around longer. You don't have to keep looking for that next new customer. Portfolio companies, private equity firms, they'll come in and they'll look at NPS. They'll look at it initially to judge how satisfied customers are, the potential companies they're going to buy. And then they go in and begin to work on the customer satisfaction level. So this is Blackbird Ventures, a private equity group. We love NPS and encourage all of our portfolio companies to use it. I will tell you from experience, again, working with the private equity firms we work with, NPS is very important. We spend a lot of time and effort improving the quality of customer service of the companies they buy, because every equity firm, private equity firm, has an exit strategy for their portfolio companies. So they know the more they can raise the customer satisfaction level, the higher the value that they're going to get on exit. So they put a lot of emphasis. Big value driver, customer satisfaction. The final one I want to talk about is called growth potential. And what this value driver is talking about is, do you operate in a market, or can you get into a market that has a lot of potential versus being in a stagnant market, very competitive market? You can only get your little slice of the pie. Growth market or not? Again, it's kind of intuitive, but the more growth, the bigger the growth market you operate in, the more opportunity you have to improve the value of your company. On an ongoing basis, there's more opportunity because you got more customers and more opportunities to sell things and products and services. You've got a growing market. It's only growing every day, so you get more and more opportunities. But in the long run, if you end up selling the business at some point in time, if you remain in a growth market, the buyer sees that potential and they realize what they can do with your business. They may have more resources to exploit what you do, and they're going to pay you a higher multiple because they see even more potential. So being in a growth market, having a growth potential, high growth potential for your products and services is very important from a performance standpoint and from an ongoing valuation standpoint. Again, we work with companies to evaluate where they stand in regard to this value driver. We'll go in and ask a question. How easy would it be to generate 5 times or 10 times the demand for your products and services if money or resources or people were no object, were not an issue? So throw those out. I mean, obviously those are limiters a lot of times, but throw those out. Let's say you can get all the people you need, all the resources you need. How easy would it be to grow demand for your product or services to 5 times or 10 times? And you answer the question. And depending on how you answer that question will determine how you answer that question will determine how you were valued for the companies that were sold. If you go in and say, it would be impossible. It's a limited market. I can only get my fair share. There's new competitors coming in every day. Probably not going to get as high a multiple as the one that says very easy. If you give me the resources and the people, I could sell 100 times what I do today. You're in that kind of market, you're going to get a much higher multiple because there's a lot of left on the table for a buyer, but it's also going to provide you opportunity to grow. So it's more a performance thing. So do operate in a growth market. It's funny, that again, that's very intuitive, but a lot of business owners don't think about that. They just go into market, something they know, without really exploring the market. And you can always adjust and get into other markets and change the growth market you're in, even after you're in business. But you need to be intentional about looking at that and finding ways to open up the marketplace that you operate in. Final case study. It's a company called Aftermail. This is Rod. He owned the company. Rod was in the software business. He had sold a company. And back during the 9/11 terrorist stuff started happening, obviously it became very important. There was an act called the Sarbanes-Oxley Act that came out that required, and one of the things it required was all the Fortune 500 companies had to have a system to store and retain emails and make them searchable, among some other things. So it has very specific requirements for this data that they collected and had that resided in their servers, but they had to find a way to store all these emails and make them searchable, among other things. The current email systems at the time didn't do that, didn't meet the standards. So there really was no software out there to meet the standards of the Sarbanes-Oxley requirements, the law that these companies had to abide by within a certain time frame. Well, Rod, software business, said, hey, there's an opportunity there. I'm going to build a system that does serve this purpose for Sarbanes-Oxley, and I'm going to sell it to the Fortune 500 companies. So he did just that. This company was called Aftermail. So he went in and he was successful in a short time frame. Once it was built, he sold 2 contracts to two different Fortune 500 companies. So he got 2 companies, and they were $1 million a year contracts to track and maintain their email system under Sarbanes-Oxley requirements. 2 companies, $2 million. So he started thinking, man, this is great. There's 498 more companies out there I can go after. But it's a long slog. It could take me a while to get another one. I'm kind of a small shop. I may be successful at getting a few more, but the longer it goes, the more competitors are going to come in, and my profit margins may get squeezed. Maybe there's a better way. It's a great growth market. Maybe there's somebody else, a bigger player, who could leverage it even more than I could, and they're willing to pay me for it. And that's exactly what happened. There's a company called Quest Software that already had relationships with all 500 the Fortune 500 companies. And he sold it to them for $35 million. And they could leverage all these relationships they already have. And granted, I'm sure they went after all the Fortune 500. I don't know how many they got, but they improved their business model. I'm sure they improved their business by leveraging what Rod had sold them in the aftermail. So growth market, find another market that somebody else could further exploit, or find a bot player who could exploit it better than you could, get paid for it. So quickly, I want to walk through the value builder system. This isn't really what this is about. I wanted to talk about the value builder elements so that you can begin to look at these drivers within your business. But our system is just that. It is a system. And it's a methodology that goes in and studies all these drivers based on a questionnaire, and it assigns a score to each of the drivers and then an overall score. The average score of the company that's gone through it initially, the 55,000 plus companies, is around a 58, 59, I believe it is, score on a scale of 0 to 100. And then when you take this score and look at all the elements within the score, and you decide which ones are high, which ones are low, where the opportunities are. Do you want to protect the high ones? Do you want to work on the low ones to build your overall score? And as I showed you earlier, the higher the score, the more value you get. So you make improvements in as many of these categories as you can, and you reevaluate. And we coach, obviously as a coach, I go in and help companies stay accountable to this. So we walk them through a kind of a curriculum to help them evaluate each of the drivers, how they would work in their business. Then we hold them accountable, and then we remeasure at the end of the engagement to see if you made progress. Again, if you raise your score up to a 90, you get like twice the industry average at a minimum on the valuation of your business. And that really is, you're now a higher performing company with less risk in it, which leads to higher valuation. And again, depending on where you score for the companies that were sold, these are the values. Obviously, multiples go up the higher your score is the point of this. So you get an overall score. You take this questionnaire, you get an overall score. And like I said, I think the 59 is the average score as of this slide for the 55,000 companies. And then each driver, let me walk you through the drivers real quick, and we'll be about to wrap up here. First one is financial performance. This is kind of the one that's really common sense. We all need to focus on financial performance. We tend to, but what's your gross margin? How do you compare to your competitors? Is your revenue growing? Is it growing adequately enough? Are you a commodity? Those kind of things. So financial performance is one of the drivers. How do you rate on that? Growth potential, we talked about with Rod. Are you in a growing market? Are you not in a growing market? What can we do to improve this element, this value driver in your business? Switzerland structure, this is kind of a unique name for it, but Switzerland, if you know anything about the country, they're kind of independent. They don't get into wars. They got their own currency. They kind of do their own thing. That's what this refers to is are you exposed to any dependence on any one employee or one customer or one supplier? So you want to be independent of that. So the more exposed you are to a limited number of either employees, customers, or suppliers, the more risk you've got in your business, because if one of those goes away, it can have a dramatic impact on you. So you want to diminish or mitigate that risk. So that's what the Switzerland structure is, concentration risk. Valuation teeter-totter. This is a cash flow value driver. As you're growing, your cash flow tends to go down because of demands. And then you say, well, I got to slow down because I'm going to run out of cash. And when you slow down, your revenue goes down. So it's a teeter-totter thing. So this helps you evaluate your cash conversion cycle, cash flow through your business to further improve the ability to fund your growth internally versus externally through funding. Recurring revenue, we spend a lot of time on that. What percentage of your revenue is recurring? Very important element. Worthy to spend time thinking about that in your business. How can I create more recurring revenue? Monopoly control. We thought, is there some element you do better than anybody else you can protect? Maybe you're the only provider of that service or product. Adds value. You should be able to charge a premium for that, and you should be more efficient because you got a higher demand for your products. Customer satisfaction, net promoter score. The higher the satisfaction level, they're going to buy more, they're going to stay longer, and they're going to recommend you. Raise your customer satisfaction level, measure it, and then do things to raise it. Hub and spoke. This is the owner's trap. Are you the hub where everything revolves around? If so, you're going to be limited on what you can do. Maybe a high limit, but there is a limit to what you can do. Not a good situation. Very risky business from a buyer's perspective. If you go away or something diminishes there's a lot of risk in the value of your business. So need to mitigate some of that impact. So our process is real simply, You go in and do a questionnaire, take an evaluation. There's an assessment done. There's a score that comes out through an assessment report, overall score, and then a score by each of the value. There's 8 value drivers. And then obviously if you want to coach, then we help coach you through that. You can take these drivers and work on them yourself as well. But then the coaching process is very structured. We help you think through and hold you accountable to working through those value drivers, adding value. And then we remeasure at the end of an engagement. Won't spend any time. It's just 12 curriculum modules, and it's a very systematic process, typically done over about a course of a year to 18 months, where you work in a module every 30 to 90 to 60 days and work on that value driver or that element. And then we hold you accountable, and then we move on to others. And you'll, all through this process, you'll choose a few that are really important, some that are you're really good at, you want to protect, and we work you through that curriculum. Ultimately, at the end, you will see your value go up by the objective value builder score, going from this to that, and it's always higher. So what's the return? You know, for me, this is really kind of easy thing, because I know objectively, through all the history of the 55,000 companies that have gone through this, that you get a great return on your investment in diving into improving these value drivers within your business. So let's say your business is worth 800, you're making 800,000, you're at the typical 3.5 multiple, you're 2.8 million. If you raise your score to 90 and everything holds true, you raise that multiple to 7.1, or a value of 5.6. So you've increased your value of your business by almost $3 million by looking and implementing and protecting these 8 drivers of value within your business. Very tangible, very real. You're higher performing, you have less risk, and hopefully you're enjoying your job a little more than you are today because you've done these things. So return on investment can be really huge just by focusing on these 8 drivers. So in summary, and we'll quit if there's some questions, we can go through those. Industry and revenue are important, but they're not the only things, and I would say not the main thing that determines value. If you know these drivers within your business, you can represent those, improve those, so when a buyer comes on, you can sell those to the buyer, and they'll be willing to pay for that. Recurring revenue is probably one of the most critical. H. Bloom was the example. Monopoly control. Could you do something in the monopoly area that you control, that you could leverage? Don't try to sell everything to everybody. Focus on something, get really good at it. Get out of the owner's trap. Net promoter score, customer satisfaction, very important. If you're above a 50%, you tend to be world class. So work on that, and leave some for somebody else. Work in a growth industry if at all possible, because ultimately a buyer is going to want to know if there's opportunity for them if they come in. So do that as well. All right. Here's the freebie. If you would like to get your own value builder score, it's like a 13 to 15 minute questionnaire. I'll send you a link, let you fill out the questionnaire, and then I'll send you a summary of your scores, and you can go act on those if you decide to, or if you want to talk to me after the fact, then obviously I'd be glad to talk to you about how we could help. So if you'll send me an email at david@petracoach.com, and in the subject line, write value builder. Depending on how many I get, and I'll get you a link. It's in the near future that you can fill out this questionnaire, and then we'll get you the summary of the questionnaire that shows your overall score and your driver scores. And then you can take that information and act on it within your company, or if you want to talk further, then we can decide then if there's something we can do for you. So anyway, that's the value builder. I know it works. There's a history behind it. There's 50-something thousand companies now have gone through this. So we know these value drivers are really important. If you focus on them, there's no way you can improve the performance, lower the risk, and ultimately the value of your company. So with that, I think, David, if you're still there, we've got a few minutes. Take any questions, or is any out there?
Thank you very much, Dave. That was spectacular. This whole methodology is something I've been very interested in here lately, and the idea of de-risking your business, is super important. I don't know if everybody's ever looked at a outline of a business plan. Usually at the end, it'll say, what's your exit plan? And I always thought that was kind of odd. Why, I'm building this business. Why would I want to sell it? But what is key is that what you're actually doing is building a business as opposed to just actually having a job, but taking all the risk on,
That's right. That's right.
So, so kind of focusing on these value drivers, if you start where you are now and just kind of work towards the future, what would be where you would start? I mean, where do you see most people start? Which driver would you concentrate on as your first step?
A couple things that you can begin to get some pretty quick return on your investment. I would definitely do a study of my recurring revenue stream, because I've really learned a lot through the private equity guys. They're pretty smart people. That is a big focus of theirs. And when they go into a business, they do everything they can to increase the percentage of recurring revenue. So look at your income stream. Is it transactional? Is it a one-off thing? You're looking for a new customer every day. If you are, think about how seriously you can do something. It does a lot of things, but it makes your business much more predictable and much more efficient if you can have a recurring revenue stream. So I would do an analysis of that. I've hardly seen any business that can't improve in that area if you spend some time. The other thing is customer satisfaction. If your customers are not happy with you, they're not going to be customers long term. So I would hit on that as well. And that's one, you got to measure it first. Net Promoter Score is a very easy way to measure. You start that survey process, and over time, the first one's not going to be the best indicator, but if you do it month after month or quarter after quarter, within some period, you're going to have a pretty good indication of satisfaction. Then you got to do things and find out, well, why aren't they satisfied? You can ask some follow-up questions and do things to improve that process. That is really valuable, David, because if you've got a satisfied customer, like I said, they buy more, they stay longer, and they're marketing for you because they're telling everybody else about it. So if there are two things you're going to focus on in every business I see can always improve in these areas, recurring revenue and customer satisfaction. Thank
you. Just a little reminder, if you have any questions, just go ahead and put them in the chat there. And another reminder, you'll get an email from us later on today with the recording of today's presentation. And if you look to the right where the chat is, there's a little button there that says Files. You can download Dave's presentation so you can have that and have his contact info right there at home. So back to the Net Promoter Score. I mean, what are the best practices to, we've all, I think, tried to do surveys with SurveyMonkey. Is there some tricks or best practices to get people to respond to this? What do you recommend?
The best time to get a Net Promoter Score is at the time of the transaction. Can't always do that, but if you've got a business that has salespeople that are working with their customers, kind of pretty relational, it's a phone call or it's a visit, get them while they're warm, and you position it in a way to say, hey, we are here, we only want to get better at what we do. And the only way we can know what we need to improve on is to ask. So could you help us? Because we want to do a better job for you. If you present it that way, they seem to be more willing to give you their feedback versus just getting a survey in the mail or an email. So the best time is immediately after the sale or at the time of the sale. If not, it's good to let them know, hey, Jim, love your business. Just know in about 10 days, you're going to get an email from us, and it's going to be a survey. It's very important that we get your feedback because we want to just deliver the best thing we can. So forewarn them that there's will be a survey coming often improves the response rate as well.
Good tips. Anne says, have you worked with a company who fell into the owner's trap and you were able to successfully coach them out of it? If so, how long did it take?
Yeah, well, it always, great answer. It depends. Yeah, a lot of the companies, no matter what size, have some kind of an owner's trap issue. They've got a senior team, and they want to be involved in everything. So it might just not be a single owner, but a senior team. Yes, and we identify those. We do. You can do a SWOT. Strengths, weaknesses, opportunities, threat matrix. We do that with every company that we coach, no matter what size they are, and identify those weaknesses or threats within their business. And often is that I've got one salesman that does 75% of my sales. That's an owner's trap issue. I'm the lead sales guy. I'm the owner, and I've brought this business, and I know every customer by now. I've got to a member that I coach right now who is that owner. He's a point of contact, and we working, attempting to get him to release some of that to somebody else. It can be done quickly if you're willing to commit to it, which means you got to go out and talk to every customer and say, hey, I'm expanding my business. Jim's now going to be the sales guy. I want you to start working with him. If you have any problems, call me, but Jim's your guy now. So you've got to be very intentional about it. So within, a year or so, you can really mitigate a lot of the impact of that situation. But it really depends on the size of the business and really what the issue is. Is it sales? Is it because all your customers call you at night and you've been too friendly with them? Sometimes you just got to have a conversation with them. Hey, I love you, but I don't want you calling me at night. I've had to have that conversation with some of our clients that we coach, because you got to have a life of your own. So it depends on the situation, but you can make a significant impact within a few months if you're really intentional about it.
That kind of leads me. When I read John Warrell's book on his Built to Sell book, and he started talking about the Switzerland structure. Mm-hmm. When you're in the owner's trap, your stress level is through the roof with your business.
Yep.
And if you can de-risk your business and have this Switzerland structure, you have a worry-free business, don't you?
Yeah. You really got to do that, because your life is only going to get worse. It doesn't get better unless you're intentional about that. But yeah, you de-risk your business. You want to have a business that you can leave. And the way we test that is kind of interesting. We don't make them, but a lot of owners who have gone through this process of de-risking their business, and we say, go away for a few weeks and see what happens. And if the business continues on okay, or even does better, then we've done a good job of getting ourselves out of the owner's trap. So do things to improve on that, de-risk your business. You want to have a business that you can just leave and it goes on without you. You really that needs to be your mindset.
Yeah. So, and that business, just to pile on, is exactly what you're talking about, because that's a business that somebody will buy. Because if I don't really know a lot about your business, if it is in a good state, in a Switzerland neutral state, then that is valuable to me. And I think that you can get numbers, transaction numbers. So you can say the range of multiples are, let's say, from 2 to 9.
Yeah.
I'm not going to go on either side of that multiple generally, but I can kind of control where I fall within that range. And that's what I want to do by building these structures in this de-risking process.
Yeah, when you go, it's interesting. I've been through a lot of transactions on both sides of this, of the buyer and the seller. And the buyer typically has more power than the seller does, because they know what they're looking for and they know what they're going to leverage. And the buyer just, hey, buy my company, will you please? Well, if I'm an active seller and I know the values within my company, then I use those as selling points when I'm pricing my business. So don't come to a gunfight with a knife. You got to have a gun too if you're going to sell your business. And this helps you represent the best picture of your business. The more you know about how these drivers work within your business.
Yeah. So here's a question. Can you create monopoly control in a commodity type business?
That's a challenge, obviously. That's a challenge. The only thing, and I can't say that I personally work with a company who has gone from a commodity to but I've seen companies that have added a feature or a function to a commodity that it becomes kind of a new product in and of itself, but it's based on an old product. Maybe an improvement in methodology. Maybe it's a new software thing that goes on it, or a circuit board that does something different that makes it a much more usable product. It's harder, and I'm not, as coaches, we don't tell you how to do it. We just encourage you to figure out ways to find out. So it can be done, but it's a little more difficult. It's definitely more difficult, but it can be done if that's your intention.
Looks like that's all the questions we have. We're a little bit past the hour. We should let everybody get back to work. Dave, this was spectacular. I really enjoyed this. I really want to thank you for coming today.
Good deal, David. Thank you for having me. And if anybody wants to score, send it to me, and we'll get something back to you.
Yeah, I encourage everybody to take advantage of that. I've gone through that and taken the Value Builder scoring, and it's really eye-opening. It's well worth the time to do it. So I encourage you to do that. And reach out to David if he can help you out. There's his contact info, david@petracoach.com. David, thank you once again. Good to see you,
everybody. Have a great afternoon.
Thanks for everybody coming today, and we'll see you next week.
All right. Bye-bye.
Bye.